$2 trillion was spent in 2017 in buying and selling companies worldwide. It's a big, big industry, and it has been growing. And all the experts are saying that it's going to continue to grow, this industry, for the next 5 to 10 years. And yet, over 70% of the deals that happen, whether you're buying or selling any company, there is a huge failure rate. More than 70% of any deals are abysmal failures within the first year after closing. So how can that be? Why are people spending $2 trillion around the world in the buying and selling of any company across different industries, across markets, when the failure rate is so high? And why is it that investors see the value in doing that? Why is this, and why are business owners doing it? We're going to focus this talk on understanding the why. Why is this happening? And why is it growing? And why are the experts saying this is not slowing down? This is the way of the future, and it's reality for all of us, no matter what type of company we're working with. We will have a Q&A question period, and I'm going to go through pretty quickly. So we're going to allocate about 15 to 20 minutes within the hour to actually ask questions. So hold on to the questions, and then we can get started. First of all, I want to give a special thanks to my home chapter, the PMI Silver Spring chapter, for inviting me to be here tonight, and also to Podcast Village, because we're actually recording this, and they produce a podcast after the event, which I make available to anyone who attends the event. Even if they don't attend, they can always come back and listen to the podcast. And we're doing that with this episode tonight. About Byond, the company that I'm with, and actually Lori Wiggins, the CEO of Byond, is here. And what we do is we provide actionable intelligence, and we work alongside business executives and owners who are looking at the possibility of either selling or buying a company. And tonight's discussion, we're going to talk about specifically, why do people consider selling their company, number one. Number two, why would anybody consider buying companies? And we're going to understand the why they're doing it. First of all, if you're on Twitter, use the hashtag digital M&A to share with your followers, and you're welcome to take pictures, take snapshots of the slides that I have, and share them, and include the @ByondMA handle, and then my own @HMDelCastillo. What we'll discuss today are all of these things. Number one, why digital M&A is so attractive to business executives, investors, and everybody else who is part of the M&A industry. And as I mentioned before, this is across industries, across markets. It's a global industry today. We're also going to cover why digital M&A is a double-edged sword, and why it's critical to reduce the failure rate that I spoke about as well. And we're going to talk about the how. What are the steps that you can take to reduce digital M&A failure? And then finally, we're going to talk about what are the things that you can do specifically to make the synergies as to why you did the deal. If you're a business owner or executive or investor, how do you make the synergies count? And we're going to define all of these things: M&A, digital M&A, and synergies. So let's get started. Why is digital M&A so attractive, so appealing to investors? So I want to start with this chart. What I want to point out about this chart, that has been now updated on a yearly basis, and the number of things go on in the internet is just going up and up and up for the last 10 years. Not only that, but the number of channels are growing, and the number of messages that are being exchanged between users is growing and accelerating. The other thing I want to point out, all of these are digital companies to begin with. And many of them are less than 10 years old, but global companies in less than 10 years. How many of you have been in the same company for longer than 10 years? And how many of you are working for global companies? These companies are all digital companies, and they're all global companies. You can pick any of those companies, they're all global. Less than 10 years old, and all digital. This is part of the reason why digital M&A is so attractive, because Digital M&A involves the buying or the sale of any company that is either a company like this in this chart, or similar competitors, or other software or software as a service type of company that has stakeholders, users and buyers across markets. The other thing I wanted to point out is that as technology changes, all these companies are buying the way we buy anything, from furniture to large appliances like a refrigerator, to the way we buy groceries today. Doesn't matter what you buy, there's always some sort of company trying to sell or effectively selling, not just online, but via mobile applications across all the categories that we buy on an everyday basis. And what it does is that it actually has changed our buy behavior. How many of you buy pizza? How many of you have the Domino's Pizza mobile app on your mobile devices? Raise of hands. How many of you are typical McDonald's customers? And how many of you are using the mobile app that McDonald's offers? Or Panera Bread? Any of those, Starbucks, any of those companies? It's an extension of what they must do to maintain market leadership. No choice, because we don't walk in anymore. And we're completely impatient waiting in line, waiting to order our coffee when we walk through any Starbucks. Those of us that are Starbucks users, we use the app, we order through the app, and we show up to pick up our coffee. We're not dealing with waiting for our cup of coffee before we can walk out with it. Sometimes even drive-through. We order ahead so that we can just drive through and get in our way, and we get mad whenever there's a queue at the drive-through window. Digital companies have changed the way we buy, and those changes are still happening today. Every day they find new ways of selling more to us, increase the size of order, increase the purchase, because it's all about increasing impulse buying for any of us when we're their target market. And the rule is that these companies focus on delivering more value to us as customers, as their customers, and that creates loyalty. This is the reason why Starbucks spent money on developing their branded mobile app. This is the way Panera Bread is doing the same. This is the reason why all of these food service restaurants are doing that. And furniture, this is why Wayfair is doing today. For those of you who are Wayfair users, furniture via a mobile app and putting a lot of bells and whistles to start preventing us from walking to an Ethan Allen or Marlowe Furniture, because we don't want to walk in before we actually see what we want to see, find it, order it, purchase it, wait for it to get there next day, same day. No waiting, frictionless, end-to-end customer experience. This is happening across industries. Companies that don't do this, they're in trouble. Sears, who owns Kmart, where are they at? Everybody's saying they're the next Titanic that are just about to go bankruptcy that can bail them out. Going down along with Kmart. We already have acquired Kmart. Us, file for bankruptcy at the beginning of this week. It's in the writing. If you're not investing in some sort of digital distribution channel, new revenue streams, even though you've been around for years, century, doesn't matter. You're going out of business if you don't figure out how to do this. Doesn't matter what industry you're in. Doesn't matter whether you're B2B or B2C or both. You need to figure out how to accelerate digital transformation. And if you haven't started, it may be too late. Just last year, 50 US retailers filed for bankruptcy. This is a retail apocalypse. And this is only the start, because the next 5 to 10 years, experts are saying that whoever doesn't have any digital channels to target customers, they will end up filing for bankruptcy in the next 5 to 10 years. 50% of retailers, doesn't matter what they're selling or who they're selling to, expected to go out of business because they don't have a digital play today and no plans to even start. Here's what Domino's has done in the last 5 years. When they first introduced their online ordering system, which was only available on their website, it took 25 clicks for any buyer to order a pizza online. And they've worked on iterating quickly, responsively, and now they're down to 0 clicks, where now the app remembers what your favorite orders are, and you can just pick up at the nearest Domino's location near you. 5 years, a chief digital officer who's a visionary and working a lot on doing a lot of A/B testing in the marketplace, just using digital channels to try to get us to buy more pizza. The end result is that these guys are now leading. Everybody else is following Domino's. 50% of their orders are coming from online and mobile apps, and about 50% just purely for mobile app users today. And if you add up the sales of Domino's Pizza a year, that's a lot of pizzas they're selling around the US. Billions of dollars worth of pizza a year, just because of their new digital channels that they're monetizing on. And everybody else is struggling, including the local independents. So digitization in itself has a lot of issues. And there's a lot of failures in digital transformation. And if you don't believe me, just ask Philip Simulus, who's Intelligent, who helps companies put together digital transformation efforts. And he can tell you a lot of stories of companies who are struggling because it's a combination of things. They either don't have the expertise, they don't have the right leadership, they don't have the right management in place. A lot of failure because nobody knows what they don't know. And it's very simple. To get business growth, it takes 3 different things that you gotta get it right. As an executive, as a leader within your company, there are 3 things that you can do to figure out how to maintain the business growing for the future. Not just today, but in the next 5 to 10 years. And it's different than actually operating and just doing. It requires to do optimization at the same time that you're doing exploration. Number 1, you need to have the right people in place. And those people will put together the recipe for how you create the secret sauce that you sell in the marketplace. And that secret sauce puts together products. And those products can be services. And that equates to revenue streams. Now that's all well and done, but if you only have one revenue stream attached to each product, that's not good enough for you to grow. In today's world, you must have multiple revenue streams for single products, and you're monetizing in different ways. The example that I spoke about before, Domino's Pizza, over the same period of 5 years, they developed 15 different ways of selling pizza to any pizza buyer that is a Domino's Pizza buyer. And many of those revenue streams are digital channels, online and mobile apps, both. Who would have thought that you could sell pizza 15 different ways? If you're a used car salesman, no difference. Same thing. You need to have multiple revenue streams when you have products to be buying. In order for you to grow the business to the next level, you've got to have multiple revenue streams across your entire product portfolio. And then allocate your people, the processes to products, and make sure that you're keeping track and measuring best-selling products, not only the size of orders, but also the frequency of the purchase, and which segments are the ones that are your most profitable customers, and start prioritizing on who are you going to go after first, and who do you defend in the marketplace. What are the kinds of customers that you want to have the highest level of loyalty because they're your highest profitable customers? Because it's not everybody. I can guarantee you that. And Domino's, part of their analytics, they know who are their most loyal customers because they're the ones that are ordering pizza 3, maybe 5 times a week. And as a business, you have to have clarity about who are those customers because it's not everybody. And one product is never for everyone. The way you present it, the way you price it is different. And you can do a lot of that via digital channels. Here's an example of mergers. These are recent mergers. Dell, a computer company, global company for a long, long time, recently merged with EMC, which is IT services, cloud service provider around the world. Both global companies, and in order to survive, they had to merge. Alcatel-Lucent, both global, multi-billion-dollar companies that sell equipment to telcos around the world. And because of so much changes in telecommunications, they had to merge. And a company that used to be headquartered in New Jersey, global multi-billion company, merged with a French company, and now the new headquarters of the merged company are in Paris. And they're not the only ones. I can think of lots of examples. And a merger is when two companies fuse together, become one company, and often they're rebranded because it's not one brand or the other, it's both brands that remain in the marketplace. These are examples of mergers. Acquisitions, on the other hand, is when there's one company that buys another company, that even though they're both in market, now the company is owned, the company that was acquired is owned by another company. An example is Orbital. Orbital has been in aerospace for a long, long time. And those of you who are in aerospace or space know that Orbital delivers a lot of work, a lot of mission critical things to Goddard and other NASA centers. Well, guess what happened about 18 months ago? Because they put together payloads for both NASA, but also for intelligence community. And what happened where Orbital, that is headquartered in Dallas, by the way, where they ended up losing a lot of shareholder value. One of their satellites blew up as it was being launched. And we're talking about, this is billions of dollars, not just in the payload, but the launch platform, and it's billions of dollars whenever something just blows up. And even if you're insured, you're not fully insured for all the losses. One mistake that they didn't even control because it probably was an act of God, and they're in trouble financially. So what did the government do? They actually tapped Northrop Grumman and said, this is a company that we cannot afford to, we gotta bail them out. And so Northrop ended up acquiring Orbital because of this one launch failure that they couldn't control. That is an acquisition. An acquisition of a local company that both Northrop Grumman is headquartered here in the DMV area. The headquarters of Orbital also here in the DMV area. And it just remains that both companies are still there today, but now Orbital is owned by Northrop Grumman. Mandiant. How many of you are in cybersecurity? How many of you know what Mandiant does? A company born and raised in Reston, Virginia, grew to about 300 employees. Very, very niche type of services where they go in and just basically do forensic analysis once a company has been breached, focusing alone on commercial company work, not federal government. And that space for the last 10 years has been growing because everybody has been hacked. These are the guys that get involved and they call in when they said, we've been breached and we need somebody to find out exactly what was taken and how much liability do we have as a business? They do forensic analysis on breaches when it's large companies that have been breached. Company, born and raised, grew to several hundreds of millions of dollars, middle market company, and then a much younger company funded for growth out of Silicon Valley called FireEye acquired them less than 18 months. FireEye, headquartered in Silicon Valley, Mandiant, headquartered here locally, and now the corporate headquarters of the owner, Silicon Valley. These are examples of acquisitions. And the majority of M&A deals are mostly acquisitions rather than mergers. So the $2 trillion that I mentioned earlier, most of that is spent on one company acquiring some other company or set of companies to get to the next level of growth. And that is called inorganic growth. Most digital companies are software companies. These, both Microsoft and Apple, are digital companies. And even though we think that many of their products were actually developed in-house, guess what? Many of those are acquisitions instead. Here's an example of all the different timeline of the most expensive, largest acquisitions Microsoft has done in the last few years. Since 2000, Look at the largest one, which is LinkedIn. And those of you that have been LinkedIn users for a while know that what's been happening to LinkedIn after Microsoft overpaid because they paid over $26 billion for LinkedIn. Skype. How many of you are Skype users? As of 2011, Skype is Microsoft. And look at this. Visio. How many of you use Visio as part of Office Suite? Visio is an acquisition. And this is typical of anyone in software that becomes a market leader. Not only do they do a lot of work of developing their own products, which is organic growth, they're also doing inorganic growth. They're doing both at the same time. Look at Apple. How many of you use Siri on your mobile devices? Well, guess what? Siri is an acquisition, not an Apple original product. Yes, they've done lots of improvements on it, but Siri originally was acquired back in 2004. How many of you are Shazam users? Shazam, the app that recognizes any song, you play the song and it tells you who's and all the words. Guess what? Just 2 weeks ago, Apple announced the acquisition of Shazam. And they're paying like several hundreds of millions of dollars. These are examples of a digital company acquiring other digital companies. And that's a lot of the work that we're going to be talking about here, specifically involves the acquisition or the merger of digital companies, when at least one is a digital company. Organic versus inorganic growth. Which one is best? Which one do you think has the highest rate of return? Is it organic growth or inorganic? How many of you say organic growth has the highest average rate of return no matter what industry you're in? Raise some hands. Okay, how many of you say inorganic growth has the highest rate of return? Okay, kind of 50-50, so to speak, in this unofficial, unscientific poll. Guess what? A study from Bain looked at 10 years across industries, and they looked at rate of return of organic growth of companies versus inorganic growth. And this is what they found. Average rate of return for inorganic growth is higher than organic growth. Hard to believe. Believe me, because I spent my life, several decades, on organic growth alone. Doing a lot of research and development, a lot of launching of products. This is where I've been for the last 20 years of my life. Working and leading project development of products, organic growth. And I see this and I'm going like, wait a minute, how can that be? When these are software companies that require a lot of technology and they have lots of expertise, and this is what this study is showing. So is it any wonder why business owners and investors have that industry of mergers and acquisitions has grown to $2 trillion a year globally? These are the numbers. And this is a recent study that was just published at the beginning of this year by Bain and Company. The same study is also pointing out that, yeah, there's a high failure rate. You know, you're looking for rate of return, but basically often, you know, the average rate of return is much lower because most deals, the failure rate is already built in. But even after you built in that high failure rate of 70% or more in inorganic growth failure, you're still getting a net gain of 4.8 compared to 3.3%, comparing organic versus inorganic. So we're going to focus today on understanding why these failure rates and what can be done to prevent these failure rates when it comes to digital M&A deals. Bottom line about this story is companies today in a fast-changing environment where all of us are changing the way we buy anything that we have been buying for the last 10, 15 years. In order for the vendors to grow, there is no choice. Focusing on one or the other, you're going to end up the same way that Sears, the same way that Kmart, the same way that Toys R Us have ended up if you invest only in one or the other and not both. Because to get to the next level of growth across industries in today's environment and moving forward for the next 10 to 15 years, you've got a company that wants to become and remain a market leader must focus programs, initiatives across both organic and inorganic growth. No choice. This is what this study is saying. And Bain is not the only one, because the McKinseys of the world, the Boston Consulting Groups of the world, everybody else is saying exactly the same thing. You can look at the literature, you'll see what they're saying. This is the impact of disruption. This is the impact that today we live in a VUCA world where we live with, there's lots of volatility, lots of uncertainty, complexity, and ambiguity in anything that we do when we're trying to sell anything to anyone. And the net effect is that you end up with lots of more competitors, much quicker than ever before, and you have to work hard at differentiating your offering and maintaining your unique value proposition in the marketplace. And in order to achieve that, you've got to focus on doing both right and allocate your people, your processes, your products, and figure out a way to move forward to get to the next level of growth. Here's examples of companies that have struggled. GE, an American icon, and today there's talks about breaking up. What happened? Because back in the Jack Welch days, for those of you that remember, that was back in the 70s and 80s, this company was doing both right, organic and inorganic growth. Went down from 150 companies that were many competing, brought down to 11 global business units, that at least 3 of those today are leaders in their space, all owned by one holding company with a GE, and now they're talking about breaking it up because they've lost their shareholder value. What happened? Well, I can tell you that they stopped the inorganic growth and they focused mostly on organic growth and trying to become from a conglomerate to a digital company, and they're a perfect example of global digital transformation failure. Bottom line is that they try to do way too much, too quickly, and ended up on the wrong side. And right now they're talking about breaking up the company in pieces, when they're leaders in GE Healthcare, medical devices, global company. The locomotive company that sells engines around the world, also a global company. And the company that sells jet engines to the Boeings and Airbuses of the world, all of those are global companies, leaders in their space, and there's talk about breaking them up. Remington, filing for bankruptcy. Gibson, the guitar company, failing for bankruptcy. Examples of companies who have failed to even start figuring out how to become digital. Here's what happens to get where the organic growth can happen, organic or inorganic. And in order to get to the next level of growth, you've got to go in stages. You got to go from sole proprietorship to small business to lower middle market to large. And here's examples of those segments of different companies by revenue and the number of companies in US today. Small businesses are companies that are between 1 to 10 million in revenue, annual revenue. There's just a few more than 961,000 companies today in US. This is according to Hoover's. Lower middle market is so large that it's split into 2 different segments. Lower middle market are companies that have annual revenues between 10 all the way up to 250 million. Over 186,000 of those companies in US today. Middle market, companies that start annual revenue at 250 all the way up to 1 billion. And just slightly above 9,800 companies in US today. And then the large companies, these are the ones that have 1 billion in revenue or more. And in today's world, even at the lower middle market, you're already beyond just selling in US, because you're already selling across markets. You're selling across borders just by your size and the number of sales, the volume of your sales. From lower middle market on up, you're going from being a domestic company that is just US only to now starting to sell outside of US and doing a lot of exporting of whatever products you're selling. So this is the natural progression of any business, is to go from small to lower to middle to large. And typically it takes about any average company somewhere between 7 to 9 years to go from one stage to another to another to another. So do the math and how long does it take a small business today to get up to the large. And let's take a look at what happens to digital companies, because digital companies, it's different. Out of the $2 trillion that I mentioned that are spent globally, more than half, 1.4 trillion in 2017, was spent on deals that involved middle market companies in US. They were either a buyer or a seller. 1.4 trillion last year was spent that involved any kind of middle market company. And just slightly more than $324 billion involved US middle companies. So whereas this involved all sorts of M&A deals that involve companies, US companies, this is specific to US middle market companies. What this is saying is the middle market has three unique value propositions. Number one, they're very diversified by the outside to enter the US market. And many of these sales that involve US middle market companies in the globalization environment that we've been in for the last 15 years, it really is a lot of foreign companies buying US middle market companies that may remain with a presence in US, but they're now owned by some foreign investor, private or government outside of US. This is what's happening, and this is only accelerating, not slowing down. Here's what Bain is saying about private equity investors who are raising funds to buy companies worldwide. And you look at the funds, and right now for last year, it's close to a record what they've raised. And the last 3 years has been a record since they started tracking this. So what this is saying is there's a lot of money out there of private equity investors looking to buy companies just to operate them and make them profitable. This is just the money side of things. So when there's a lot of money and there's companies that are very attractive, where in today's market, what is happening to the US currency compared to foreign currency? Has anybody been tracking that since beginning of last year? What's been happening to the value of the US dollar against the euro, the yen, the other foreign currencies? It's going down. So what does that mean when you're a private investor that is raising euros instead of dollars? You can buy very cheap right now, even if your multiplier is high when you're a US company. And there's a surplus of cash right now looking to buy companies to operate. What really happens to software companies? Here's what McKinsey's saying we looked at last 20 years of software companies, and we see that for them, getting to $1 billion, which puts them into the large company category, is not enough. As a matter of fact, most companies have to reach $4 billion in revenue in order for them to remain market leaders for the next decade and a half. And there's so much churn. Look at the list. This was published back in 2015 by McKinsey when they did the study. And they said, out of all these companies that get started, from small business to all the way to large companies, and even though they're $1 billion, for software companies, there's a lot of churn, and even just getting to $1 billion in annual revenue isn't enough for you to remain a market leader. It's $4 billion in revenue at least or more in order for you to be considered in the top 20 software companies. And that includes everybody from Facebook to IBM to Google to Microsoft. All those are the ones that back in 2013 made it to $4 billion in revenue or more. And we're going to talk about what's happening since 2013, because if you notice, AOL and Yahoo are listed there. We're going to learn what happened to them since 2013. So while most acquirees are seeking 26% out of rate of return of any deal, guess what happens when they're looking to trade any kind of digital company? They're valued higher, they have a higher expected growth rate. Most investors are looking to get an average rate of return higher than 60% anytime they are purchasing a software company. So therefore, they're the most sought after companies today. And this is why getting to $1 billion in revenue is not enough. You need to get to $5 billion or more in order for you to be a large conglomerate that can now start considering that you're going to remain a market leader. An Oracle, a SAP, those kinds of companies. So number one, digital companies achieve a lot of rate of return much higher than any other industry. And often they're supplying multiple industries, not just one, and that's what makes software companies attractive. When you look at Microsoft, are they selling into one industry or multiple industries? And is there one industry they depend on for selling Office Suite or their operating systems? No, they have very diversified portfolios, and even though they sell to enterprise users, they're selling across industries. And this is why Microsoft is a market leader, because their portfolio of customers today is diversified and they're global customers. This is why these software companies are achieving a much higher rate of return compared to anybody else, no matter what industry you're in. Very sought after companies, and a lot of cash available looking for the next software company that just takes a little dip in valuation so they can be acquired at the right time. However, digital M&A it's a double-edged sword. And this is a study that just came out recently at the beginning of this year by McKinsey that says there are 3 factors that make digital M&A risky, because if you do too little or none, it's an issue. If you do too many, it's an issue. We're going to talk about 3 factors that make a digital M&A a double-edged sword, and you need to make sure that you're maintaining your cadence as you're trying to grow the company. Number 1, low volume M&A initiatives, programs that are about just figuring out who do you buy or who do you sell to and why, usually disrupt the growth of the entire company. Even if you're focusing 80% of your funding in organic growth and only about 20%, if that balance is not right, too few deals, and it's actually disrupting or interrupting your organic growth opportunities. High volume initiatives accelerate business growth. Facebook and WhatsApp. WhatsApp, the original founders came out of Yahoo. When they were turned down by Yahoo to develop the idea of what they had, they got turned down by the Yahoo CEO at the time. It was not Marissa Mayer, it was somebody else, because this was back then. And they ended up putting together the business model, and in less than 3 years, they were acquired by Facebook for billions of dollars. FriendFeed is another acquisition by Facebook. And Facebook is one of the $4 billion companies that I spoke about in the previous study. Here's the next one. Successful digital acquisitions complement organic growth. So as I mentioned before, no different than what I was saying, in today's environment, companies need to focus on both, not one or the other, organic and inorganic, and look for synergies between the two. And here's what's happening in cyber. Cyber, now there's even bigger companies buying out startups. Just like FireEye acquired Mandiant, there's all sorts of different companies looking for startups to bring them in their portfolio and accelerate the business growth when they are looking for end-to-end frictionless solutions that are cyber security services. Even when these are services, software as a service solutions, platforms. Number 3, successful digital acquisitions align with your growth strategy. And what that means is that you have to communicate clearly the significance of inorganic growth to your workers, just like there is so much emphasis in organic growth. And actually with this, it's very important for you as project managers or program managers of organic growth initiatives to make sure that you have a counterpart and that you're communicating about where are the synergies between the organic growth that you're leading and the inorganic growth that is about to be done, because that's what it takes to create synergies between the two. Why reduce M&A failure? Well, I can tell you there are 7 reasons, and we're going to go through them very quickly, from the 7 all the way counting down. Number 1, you want to avoid considerable job loss, because M&A failure means that the end company shrinks rather than grows. And it shrinks by downsizing. Think about where BlackBerry is today, formerly RIM, and what happened to it when they were multi-billion dollars. They lost the value, did not focus on our inorganic growth, and they ended up losing lots of jobs. Kodak, the same way. Number 6, avoid massive financial and non-financial losses. Financial losses are easy, right? Revenue, profit drops. What are non-financial losses? Those are the benefits, the appeal of the workplace, because you normally allow people to work out of home or from anywhere 3 days out of the week, and now you're forcing them to come back into one location, and now they're forced to commute when they were used to not commuting. What does it mean for you to not have to report to the office in the DMV area anywhere you work when your average commute is 10 miles or more? And how happy are you, no matter who you work for? Number 5, avoid negative growth outlook. We pointed out earlier that no organic growth, your growth outlook is stunted, meaning instead of you getting an increase or flattened sales, your sales are dramatically declining. Number 4, avoid giving advantage to your competitors. Where do your key employees, your best employees go when you end up having to lay them off? Case scenario, your best employees go and work for your direct competitor. 3, avoid losing your unique value proposition. This is exactly what happened to BlackBerry. And the winners are Samsung and Apple when BlackBerry had to shrink. 2, avoid substantial customer loss. When you start losing customers, it's really hard to regain them, especially when there's a lot of Me Too's out there. A lot of competitors say, yeah, me too, me too. And this was exactly what happened to EMC and Dell, and the reason why they had to merge. Prevent long-term reputation damage. Long-term reputation damage is exactly the same thing that happens to companies that just don't keep up, and this is the Sears example. That even though they're still there today, everybody's saying there's no turnaround. It's like the Titanic after they have struck the iceberg. It's only a matter of time before they go down. We're going to talk about 7 steps to prevent failure. Number 1, you set a compelling vision. What this means is if you're an executive business leader, you communicate to your employees the critical importance of doing both organic and inorganic growth, and then assign leaders to lead the efforts and communicate to make sure that you create synergies. It starts with a compelling vision from the founders to say, yeah, even though we're technologists, we know that in today's world, we can't just rely on organic growth alone, which is the biggest mistake that you're doing when your CEO is really a CTO in disguise. This is what Amazon has done so brilliantly. AWS, everybody who leases AWS infrastructure, here's all the acquisitions they've done over time. And that includes, by the way, Whole Foods. Last year, over $17 billion they paid for Whole Foods. They are now a grocery store. And Ring, that was just announced less than a week ago. IoT company, video doorbell. Number 2, assign a champion. Assign somebody at the C-suite level, a co-founder, somebody to lead inorganic growth. And in today's world, you might actually have to create a new C chair, like a chief digital officer, chief data officer, or maybe chief M&A officer? I don't know. Here's an example, Apple and Shazam. Most recent acquisition that Apple just announced less than 3 weeks ago. Corning Glass partnership provides glass for any mobile device that Apple sells, a US company, and they announced that out of the $1 billion fund that they are investing back into manufacturing US companies, $200 million will go to Corning here in US, just to work on the next generation of glass for mobile devices. And there's talk about if Tesla ends up in trouble, they're going to end up acquiring Tesla at some point, or maybe buying into it. Number 3, build team of expert advisors. And that means that when you're a Cisco, you actually disrupted the telco world. You now look for the next opportunity, and now they bought a SourceFire, which is actually a Columbia, Maryland company, grew to 3,000 employees, and the same founder grew it to 3,000 employees from 1 employee, the inventor of Snort, and he just sold to Cisco less than 18 months ago for over $3 billion. What do you think is happening to the jobs here in Columbia, Maryland, when this company is now headquartered in Silicon Valley? Number 4, enhance your value proposition. Verizon acquired in the same 12-month period Yahoo and AOL, both in the 2013 study. They were both over $4 billion companies, and both got into trouble, and now they're owned by Verizon, and AOL is now being rebranded as Oath here in Dulles. Evolve your business model. Discovery headquartered here. 3 years ago, they knew that they were going to buy this, and this is a multi-billion-dollar acquisition of Scripps. Scripps is a producer of any of these channels that probably we view. We don't know who's behind it. Scripps is one behind it, and in the announcement, they're moving development to outside the DMV area, and they're moving the Discovery headquarters to New York City. How can you justify the cost of living of moving your corporate headquarters to Manhattan, to the cost of living in Silver Spring, Maryland? but this is happening. It's already been announced. By 2019, Discovery will be out of Silver Spring, all because of this acquisition. 6, always seek new ways to achieve synergies. Oracle acquiring Micros. Micros being a Colombia born and raised company, middle market company, now owned by Oracle out of Silicon Valley. Google acquiring Xylee. And this is basically part of the IoT play. Anybody who wants to have an IoT platform to control devices as a service, Google now owns them. They just announced the acquisition, and this is a New England company. Number 7, integrate quickly and responsibly. Once you acquire, you gotta move and acquire. Here's another mega in the healthcare. CVS actually acquiring Aetna, health plan provider. And a lot of integration because these companies are large both. It's gonna take them at least 3 years to integrate. Moving forward, not so clear they're gonna be successful if they don't work on integration. A summary of the 7 steps. Last points, 3 things. How do you make the synergies count? Number 1, opportunities are time-based. If you don't anticipate them, I guarantee you cannot outreact. You've got to anticipate so that you can plan accordingly and align your people, your processes, and your products because you have to work at not missing the opportunity. Perfect example is Marriott just acquired SPG. And now through that acquisition, Marriott is again the largest hotel chain in the world. And when you ask the CEO why he bought SPG, he says, anybody in this industry knows that this opportunity comes only maybe once every 20, 25 years. If we didn't move on this, somebody else would have, and we just took the opportunity to do so. And now we're back on top. Marriott headquartered in Bethesda. Companies fail to push beyond the benefits that first justify the synergies are so critical that not only do you identify them pre-deal, but even during the due diligence and post-deal, you have to work at identifying even more synergies, especially when you're a software company, because getting that high rate of return means that you always have to look for more and more synergies, even as you're closing the deal. Acquirers who announce the synergies get rewarded by investors, shareholders, customers. And that's why they grow, and that's why they can achieve a very high rate of return. Without announcing that, it's basically about integrity and about earning the trust of your customers, investors, shareholders. And the ones that do and walk the talk, announce it, execute it, are the ones that become market leaders.